Welcome back to our International Financial Management course. We will review the letter of credit today. This lecture is part of our International Trade Finance lecture series. Let's begin. What is a letter of credit? A letter of credit, LC, is a financial instrument issued by a bank on behalf of an importer, buyer, that guarantees payment to an exporter, seller, upon fulfillment of specified conditions. It ensures that the exporter receives payment once the required documents, such as shipping and insurance certificates, are presented and verified to comply with the terms of the LC. Letters of credit are governed globally by the Uniform Customs and Practice for Documentary Credits, UCP 600, established by the International Chamber of Commerce, ICC. They are one of the most widely used mechanisms for securing international trade transactions, especially when the buyer and seller are in different countries and do not have an established relationship. Why are letters of credit important? Trust and security. The seller is assured of receiving payment once documentary conditions are met. Risk reduction mitigates payment risk for the exporter and performance risk for the importer. Facilitation of trade enables trade between unfamiliar partners or countries with differing regulations. Access to financing. Exporters can use an LC as collateral for pre-shipment or post-shipment financing, global standardization, uniform global rules, UCP 600, simplify and standardize the process. What risks does a letter of credit mitigate? Credit risk. The exporter no longer depends on the buyer's ability or willingness to pay. The bank guarantees payment. Performance risk. The importer is protected because payment occurs only after presentation of compliant documents proving shipment of goods, country and political risk. If a buyer is in a politically unstable country, an LC issued or confirmed by a reputable international bank can reduce risk exposure. Currency risk. LCs can be denominated in a mutually agreed currency, reducing exposure to exchange rate volatility. Documentation risk. The LC requires standardized documentation, ensuring that trade records are clear and verifiable. Fraud and miscommunication. Clearly defined document requirements reduce ambiguity and fraudulent claims. Types of letters of credit. Revocable LC. Can be modified or canceled by the issuing bank without prior notice to the beneficiary, rarely used due to lack of security for exporters. Irrevocable LC cannot be changed or canceled without agreement from all parties involved, provides the highest level of protection, and is the standard form under UCP 600, confirmed LC. In addition to the issuing bank's guarantee, another bank, usually in the exporter's country, adds its confirmation, providing extra assurance of payment. Unconfirmed LCO, only the issuing bank is obligated to pay, used when the exporter trusts the issuing bank or the importing country's banking system. Cite LCE, payment is made immediately upon presentation of compliant documents. Usance, deferred. LCE, payment is made at a specified future date after shipment, for example, 30, 60, or 90 days from bill of lading date. Standby LC acts as a backup guarantee that is only drawn upon if the buyer fails to meet payment or performance obligations. Revolving LC automatically reinstates its value after each drawdown, suitable for ongoing shipments under a long-term trade contract. Transferable LC allows the beneficiary to transfer part or all of the credit to another supplier, useful in intermediary trading. Back-to-back LC issued when the exporter uses a master LC from the buyer to open a secondary LC to pay a supplier. Red clause LC allows the exporter to receive an advance payment, usually partial, before shipping goods. Green clause LC. Similar to a red clause LC, but also includes storage and insurance costs in the pre-shipment advance. Parties involved in a letter of credit. Applicant, importer, buyer, requests the LC from their bank to guarantee payment to the exporter, issuing bank, the buyer's bank that issues the LC and guarantees payment to the exporter upon compliance. Beneficiary, exporter, seller. The party entitled to receive payment once documents meet LC terms. Advising bank. The exporter's bank that authenticates and transmits the LC to the exporter. Confirming bank. Adds its own payment guarantee, usually at the exporter's request, providing an additional layer of protection. Negotiating bank. Examines the documents, negotiates payment, and forwards them to the issuing bank. Reimbursing bank. Provides funds to the negotiating bank upon payment authorization. Carrier/shipping company. Provides transport and shipping documents, for example, bill of lading. Insurance company. Issues insurance documents covering transit risks. Step-by-step LC process. Contract agreement. The importer and exporter sign a sales contract specifying payment by LC. Application. The importer applies to their bank, issuing bank, for issuance of the LC in favor of the exporter. Issuance. The issuing bank sends the LC to the advising bank in the exporter's country for authentication. Advising. The advising bank reviews and forwards the LC to the exporter beneficiary. Shipment of goods. The exporter ships the goods according to LC terms and collects the required documents, invoice, bill of lading, insurance, etc. Document submission. The exporter submits the documents to the advising or negotiating bank for verification. Examination of documents. The bank checks documents for compliance with the LC's terms under UCP 600 rules, payment or acceptance. If documents are compliant, payment is made, cite LC, or accepted for future payment, Usance LC. Document transfer. The documents are sent to the issuing bank, which delivers them to the importer upon payment or acceptance. Settlement. The issuing bank reimburses the negotiating or confirming bank and debits the importer's account. Finalization. The importer uses the documents to take possession of the goods from the carrier. This concludes our discussion about the letters of credit. See you at the next lecture.